Personal loan interest rates are essentially the price of a loan, the cost you pay to borrow money. Yet, if you've ever shopped for a personal loan, you know rates can vary dramatically from person to person. For example, some lenders offer APRs as low as around 6 to 7% for highly qualified borrowers, while others with less than perfect profiles might see rates climb to 30 to 35% or more. This wide range can be mystifying, but it isn't random. According to financial experts, many factors determine your rate, including shifts in the economy, the type of lender you apply with, and your credit profile. In other words, both your personal financial situation and the broader market conditions influence the rate you'll be offered. Why do lenders charge different rates to different customers? The answer lies in how lenders set prices. Most banks use a cost-plus model for loan pricing. They start with their cost of funds, what it costs them to obtain the money they lend, and then add margins for operating costs, the risk of borrower default, and a profit margin. If a borrower is deemed riskier, the lender adds a larger risk premium to compensate for the higher chance of loss. By contrast, a very creditworthy borrower is less risky, so the lender can offer a lower rate while still covering costs and earning profit. In short, your personal loan interest rate is a reflection of both your risk level in the lender's eyes and external factors, like prevailing interest rates and competition. In this guide, we'll break down how lenders calculate your personal loan rate. We'll explain what a personal loan interest rate really means, discuss the key factors lenders look at, from your credit score to the economy, and show you how those factors translate into the APR you're offered. By understanding this process, you'll be better prepared to anticipate your rate and even improve it. Let's start with the basics of what an interest rate is, and then explore the factors that decide whether your rate is on the low end or the high end of that broad range. A personal loan interest rate is the percentage of the loan amount that a lender charges you each year as the cost of borrowing. This rate is often expressed as an annual percentage rate, APR, which may also include certain fees. In simple terms, if you borrow money, the interest rate/APR is how much extra you pay on top of repaying the principal. Lenders charge interest as compensation for lending money. It's essentially how they make money on the loan. For example, if you have a 10% annual interest rate on a $10,000 loan, you'll owe about $1,000 in interest per year, before considering any principal payments. Importantly, your personal loan's interest rate is not chosen arbitrarily. It is typically based on several factors, including your credit score, the type of loan, and even your relationship with the lender. In the context of personal loans, the interest rate and APR are often used interchangeably, especially if the loan has no additional fees. However, it's good to know that APR represents the total annual cost of a loan, including interest and any fees or charges. A loan with a 10% interest rate and no fees will have a 10% APR, whereas a loan with a 10% interest rate plus an origination fee might have a higher APR. Always check whether a quoted rate is the interest rate or the APR, but for simplicity, we'll refer to APR when discussing your rate. Another aspect to understand is that personal loan interest can be fixed or variable. A fixed interest rate stays the same throughout the life of your loan, so your monthly payments are predictable. A variable interest rate can change over time, usually in line with an index or benchmark. Many personal loans come with fixed rates, but some loans, or personal lines of credit, have variable rates that move with market interest rates. For example, a variable rate loan might be tied to the prime rate or another benchmark. If the benchmark rate goes up, your loan's rate and payment can increase, and vice versa. As one resource explains, fixed rates remain static throughout the life of the loan, while variable rates can change with the market. We'll discuss how lenders decide between offering fixed versus variable rates and how those are determined in a later section. First, let's look at the factors about you that lenders scrutinize when setting your personal loan rate. When you apply for a personal loan, lenders evaluate a variety of criteria, to decide what interest rate to offer you, or whether to approve the loan at all. Essentially, they are judging how risky it is to lend you money and what costs they need to cover. Here are the key factors that influence your personal loan rate. Your credit score is perhaps the most important factor in a lender's interest rate decision. This three-digit number, typically ranging from 300 to 850, sums up your creditworthiness based on your past borrowing behavior. Lenders heavily rely on credit scores and the underlying credit report data to predict the likelihood that you will repay the loan on time. Not surprisingly, a higher score usually means a lower interest rate offer, while a low score leads to a higher rate. In fact, lenders commonly use risk-based pricing. Most lenders consider your FICO score when determining your interest rate, and borrowers with FICO scores above 670, good to exceptional credit, typically qualify for the best rates. By contrast, if your score is in the fair or poor range, you'll likely be offered a much higher APR, or you may only qualify with certain subprime lenders. What counts as a good or bad credit score? Generally, credit score ranges can be described as follows. Approximately 720 plus is excellent. 690 to 719 is good. 630 to 689 is fair, and below 630 is poor. Each lender might define these bands a bit differently, but the idea is the same. A borrower with a 750 score has a proven track record of responsible credit use, so lenders see them as low risk and charge a lower rate. A borrower with a 580 score has multiple red flags, like late payments or high debts, and is seen as high risk, so if they're approved at all, the lender will demand a higher rate to compensate for the risk of default. For example, one Federal Reserve study noted that a customer with a credit score of 710 has a roughly 1 in 21 chance of default, whereas a score of 680 corresponds to a 1 in 11 chance. So the lower score borrower must pay more interest to offset the higher default probability. In practical terms, your credit history, including your payment history, any delinquencies or defaults, your total debts, and how long you've used credit, all feed into your credit score and thus your rate. Lenders will often review the credit report details as well. Consistently on-time payments and a clean credit history put you in position for the lowest rates, while issues like late payments, collections, or a short credit history will increase the rate. The takeaway: maintaining a strong credit score is crucial for securing a low personal loan rate. We'll discuss tips to improve your credit in the section on getting a better rate. Besides credit, lenders care a lot about your ability to repay the loan. This is where your income and debt-to-income ratio come into play. Income is the money you earn from your job, business, etc., and is a core part of any loan application. Lenders usually have minimum income requirements to ensure you can afford the loan payments. They will ask for proof of income, like pay stubs or tax returns, and verify your employment. A higher, stable income gives the lender confidence that you have the means to repay, which can help you get approved and possibly snag a better rate. In fact, data shows that high-income borrowers with strong credit tend to get the lowest rates because they present a very low risk of default. However, income alone isn't the full story. Lenders also look at your debt-to-income (DTI) ratio, which measures your monthly debt obligations against your monthly gross income. This metric indicates how much of your income is already committed to debt payments. A lower DTI suggests you have plenty of breathing room to take on a new loan, whereas a high DTI means your budget is stretched thin. DTI is often a deciding factor in loan underwriting and pricing. Lenders prefer to see a DTI below a certain threshold, commonly around 35% to 40%. As Lending Club explains, a DTI below 40% is ideal. Anything above this can signal to a lender that you might not be able to repay your loan. If your DTI is very high, for example, 50% or more of your income goes to existing debts, you may be offered a higher rate or even denied because the lender worries you won't comfortably manage the additional payment. In summary, a solid, steady income and a low DTI ratio can earn you a better interest rate. They demonstrate financial stability. Lenders will typically calculate your DTI from the credit report, which shows your existing debts, and the income documents you provide. If you have a high income and relatively little debt, you're a favorable candidate. Conversely, if you're living paycheck to paycheck with significant debt, a lender might only approve you at a steep rate to buffer the risk. One NerdWallet analysis noted that beyond credit scores, those with low debt and high income tend to secure the lowest rates available. This is why paying down debt before applying to improve your DTI or choosing a smaller loan amount, more on that shortly, can lead to a better rate offer. The details of the loan you're requesting, particularly the loan amounts and the repayment term, also factor into your interest rate. Lenders often adjust rates based on how big the loan is and how long you'll be paying it back. Loan amount. The size of the loan can influence your rate in a couple of ways. A very small loan might come with a slightly higher rate due to fixed processing costs that the lender needs to cover, though this effect is more pronounced with things like microlending. On the other hand, applying for a very large loan relative to your income could trigger a higher rate or stricter evaluation, since it represents more risk for the lender. Some lenders have tiered rate ranges. For instance, they might offer their lowest advertised rates only on loans above a certain amount, e.g., $10,000, and charge higher rates on smaller loans. But broadly speaking, borrowing more than you need can backfire. If you can meet your needs with a smaller loan, it may not only save you interest overall, but could also help you qualify for a lower rate. This is because a lower loan amount reduces the lender's exposure. As one guide notes, applying for a lower loan amount can often help land a better interest rate, and also improve your chances of approval. It can prevent you from being bumped into a higher risk category or paying for unnecessary extra debt. Loan term. The term, length of repayment period, usually comes with a trade-off between the monthly payment amount and the interest rate. Shorter-term loans, e.g. 2 years, generally have lower interest rates than longer-term loans, e.g. 5 or 7 years. Lenders view a shorter loan term as less risky. There's less time for things to go wrong, and they get their money back sooner. So, they often reward borrowers who opt for a shorter payoff period with a modestly lower rate. From the borrower's perspective, a shorter term means higher monthly payments but a lower total interest cost. By contrast, a longer-term loan gives you a smaller monthly payment, which can be easier on your budget but usually comes with a slightly higher interest rate and definitely more interest paid over the life of the loan. For example, one credit union illustrates that a 1-year personal loan might carry a rate around 6 to 7%, whereas a 5-year loan might have a rate a bit higher, and the total interest paid could be double or more due to the longer time frame. In general, if you can comfortably afford the larger payments of a shorter term, you'll save money with both a lower rate and fewer months of interest accrual. It's worth noting that some lenders have specific rate term policies. They might advertise a range like X% APR for 24 months, Y% for 60 months, etc. Others might keep the rate constant but simply accumulate more interest over the longer term. Always check how the term affects your offered rate. But as a rule, shorter equals lower rate and less total interest in many cases. Lenders like shorter terms because their risk exposure drops, and borrowers get a reward in the form of a rate discount. Personal loans come in 2 main varieties: secured and unsecured. An unsecured personal loan is not backed by any collateral. The lender is giving you money based solely on your promise to repay and your credit chart income profile. A secured loan, on the other hand, requires you to put up an asset as collateral. For example, Some banks let you secure a personal loan with a savings account, or you might take a loan against your car or another asset. The presence of collateral has a direct impact on your interest rate, because secured loans give the lender a specific asset they can claim if you default. These loans carry less risk for the lender. Consequently, secured personal loans often have lower interest rates than equivalent unsecured loans. The collateral functions as a form of insurance for the lender. If you fail to pay, they can recover their money by seizing the collateral. Therefore, they don't need to charge as high an interest rate to compensate for default risk. For example, if you take a personal loan secured by a certificate of deposit, CD, or a car title, you might get a significantly better rate than an unsecured loan, assuming all other factors are the same. Most standard personal loans offered by banks, credit unions, and online lenders are unsecured, which is why the interest rates are generally higher than rates on secured loans like auto loans or mortgages. Those have collateral. If you have weaker credit or want a larger loan than your credit alone would justify, offering collateral can be a way to qualify more easily or get a lower APR. Not all lenders offer secured personal loans, but some do, and they might advertise a rate difference. For instance, a lender might say, their unsecured loans range from 7% to 20% APR, but a share-secured loan might be 3% to 5% APR, since the default risk is minimal with cash collateral. Important caution: while a secured loan can lower your rate, remember that you are putting an asset on the line. If you don't repay, you could lose that asset. Lenders will still evaluate your credit and income, but collateral tilts the odds in your favor. In summary, unsecured loans will price in more risk, higher rate, because the lender has no fallback if you default, whereas secured loans transfer some risk to you, the borrower, by using your asset, and thus the lender can afford to charge a lower interest rate. Consider this when shopping. If you have an asset you're willing to pledge and need a lower rate, a secured loan might be an option. Not all lenders will give you the same rate, even for the exact same borrower profile. Each bank or lending company has its own pricing model and criteria. That's why it's crucial to shop around. Interest rates can vary widely by lender, so shopping around to compare rates can help you find the best deal. Some lenders specialize in prime borrowers and offer very low rates to top-tier customers, and might decline subprime applicants entirely. Others cater to borrowers with lower credit and thus charge higher rates on average. There are also differences between lender types. Generally, credit unions and banks may offer slightly lower rates, especially for well-qualified borrowers, compared to some online or fintech lenders, because banks and credit unions often have lower cost of funds and may not seek as high a profit margin. For instance, as of late 2025, the average 2-year personal loan rate at commercial banks was about 11.5%, while many online lenders offer APR ranges spanning from roughly 6 to 7% up to 35%, depending on the borrower. Meanwhile, many federal credit unions cap personal loan rates at 18% by regulation, potentially benefiting medium credit borrowers with a moderate rate. The point is, the lender you choose matters. It can be the difference of several percentage points on your APR. Additionally, lenders have different eligibility criteria and internal scoring systems. Two lenders might look at the same person, and one could categorize them as higher risk than the other does. Some lenders might put more weight on your credit score, while others focus on your income or cash flow, or even use alternative data. This means if one lender gives you a high quote, another might give you a lower quote. It pays to check at least a few options. Without harming your credit, many allow soft pulls for rate quotes. Another factor in this category is your existing relationship with the lender. Many banks offer a relationship discount on interest rates for their customers. For example, a bank might knock 0.25% off your APR if you have a checking account with them and set up automatic loan payments from that account. This is common at major banks, e.g., Wells Fargo, Bank of America, Chase, and others, have such discounts for auto pay or loyalty. Being an existing customer can also sometimes make the approval process easier or qualify you for special offers. Lenders like to reward loyalty, and automated payments reduce the risk of missed payments, which is why they give a discount. According to Wells Fargo, to get their relationship discount, you need a qualifying deposit account and auto pay setup. And if automatic payments are canceled, the interest rate may increase. The 0.25% gets added back. While a quarter point may not sound huge, it does save money over the life of the loan, especially on large balances. Key takeaway: each lender sets its own rate based on a combination of your factors and their business strategy. Some aim to be very competitive on rates for top-tier borrowers. Others charge a bit more but might offer faster service or approve riskier loans. Always compare offers from multiple lenders before committing. It's not uncommon to see one lender offer, say, 8%, while another offers 11% to the same person, just because of different models. Indeed, personal loan rates are highly competitive, and lenders know you might check around. Use that to your advantage. And if you have a bank or credit union you've been with for years, inquire there too. Your history as a customer could help you secure a slightly better rate or terms. So far, we've focused on personal factors, but there is a bigger picture. Market interest rates and economic conditions set the backdrop for all loans. Lenders don't decide your rate in a vacuum. They are influenced by the prevailing interest rate environment, chiefly guided by the Federal Reserve or central bank rates and overall economic trends. Here's how these external factors come into play. Federal Reserve and prime rate. In the U.S., the Federal Reserve's policies heavily influence short-term interest rates. When the Fed raises the federal funds rate, the rate banks charge each other for overnight loans. It tends to push up interest rates across the board, including personal loan rates. When the Fed cuts rates, borrowing generally becomes cheaper. Personal loan rates tend to rise and fall as the Fed rate rises and falls, notes one explainer. Many lenders use the prime rate, which moves in tandem with Fed rate changes, as a benchmark for their loan products. Variable rate personal loans usually are quoted as prime plus X%. For example, if the prime rate is 5% and the lender's margin for your risk level is plus 8%, your variable APR would be 13%. As the prime rate changes, your rate changes. Even for fixed-rate loans, lenders adjust their offered rates for new loans based on market rates. If overall interest rates in the economy are high, the floor for personal loan APRs shifts higher. If the Fed slashes rates to stimulate the economy, new personal loans will start coming out with lower APRs on average. It's important to note that Fed rate changes don't always translate immediately or equally to personal loan rates, and personal factors still dominate. In fact, one financial advisor explained that while Fed moves impact lenders' cost of funds, your credit score and financials often play a bigger role in determining your rate than the Fed's actions. Still, over time, the Fed's rate environment sets the stage. For instance, in 2022 to 2023, the Fed hiked rates significantly. As a result, the average personal loan APR at banks rose from around 9% to over 11%. If you took a loan in that high-rate period, you might have paid more than someone with identical credentials who took a loan when rates were lower. Cost of funds and competition. Lenders get the money they lend out from various sources: customer deposits for banks, capital markets, etc. If it costs more for lenders to obtain funds, they will charge higher interest to borrowers. For example, a bank largely funded by deposits will look at the interest it must pay to depositors. If savings account rates and CD rates are high because of market conditions, the bank's cost of funds is high, and loan rates must be higher to maintain profit. Non-bank lenders might rely on credit lines or investors. If those investors demand higher returns, due to market shifts, the lender will quote higher loan rates to meet that return. On the flip side, in very low-rate environments, lenders can access cheap money and thus offer lower loan rates. Competition also plays a role. If many lenders are competing for borrowers, they might squeeze their profit margins to offer lower rates than rivals, especially for well-qualified borrowers. In a tight competition scenario, you might see even sub-10% APRs being offered to prime borrowers because lenders are aggressively pricing loans. But if credit tightens and fewer lenders are willing to lend, the offers you receive could all be on the higher side. Economic outlook. Lenders also consider factors like inflation, employment, and economic growth. If the economy is doing well and default rates are low, lenders may be more relaxed and keep rates moderate. If there are signs of a downturn or higher default risk in general, lenders could raise interest rates or tighten approvals to protect themselves. Additionally, if loans are often packaged into asset-backed securities, as some personal loans by fintech lenders are, the demand from investors for those securities will influence rates. In times of uncertainty, investors require higher yields, which translates to higher APRs on the underlying loans. In stable times, those yields and APRs come down. The Minneapolis Fed highlights that funding costs like Treasury yields or other benchmarks, plus margins for risk and profit determine loan pricing. So if, say, the 2-year Treasury rate, a rough benchmark for 2 to 3-year loans, is up, that base cost is up and trickles into personal loan offers. In summary, market conditions set the baseline for interest rates at any given time. Lenders then add adjustments based on individual factors. Think of it this way. You have your personal risk profile, which might say you deserve prime plus 5%, for example. Where prime or another base stands will dictate the final number. During some periods, prime might be 3%, making your rate approximately 8%. In other periods, prime might be 7%, making your rate approximately 12%. You can't control the economy, but it's good to be aware of it. Fortunately, if you lock in a fixed-rate personal loan, your rate won't change even if the Fed moves rates next week. It only affects new loans. And if rates drop significantly, you might be able to refinance to a lower rate. If you have a variable rate loan, then market changes will directly affect your rate. Most personal loans are fixed, but personal lines of credit or certain variable offers will clearly state that the rate may fluctuate with the prime rate. One caution: trying to time your loan to get the perfect rate is tough. Rate moves are hard to predict, and lenders don't always adjust rates right away. So waiting on a Fed decision might not yield a significantly better deal. Focus more on what you can control: your credit, income, shopping around, and be aware of the market as a general backdrop. Now that we've covered how lenders decide your personal loan rate, you might wonder, what can you do to get a lower rate? While some factors, like the economy, are out of your hands, many of the personal factors can be improved with some planning. Here are some effective strategies to help ensure you land the most favorable interest rate possible. Boost your credit score. Since credit score is the #1 factor, improving it can directly lead to lower rate offers. Check your credit report for errors and correct them. Make sure to pay all your bills on time. Payment history is huge in scoring. Pay down credit card balances to reduce your utilization ratio. If your score is just below a cutoff, e.g., 660, even a modest increase could move you into a better tier. FICO scores above 670 qualify for the best rates, notes Lending Club, and the best offers go to those in the good, excellent range, 720 plus. If your score is not there yet, consider waiting to apply until you can raise it. The difference in interest could be substantial. For example, moving from a fair score, approximately 650, to a good score, approximately 700, might drop your APR by several percentage points. Practical steps include paying off small debts, avoiding new credit inquiries, and perhaps using tools like credit builder loans or secured credit cards to establish positive history. Improving your credit might take a few months to a year, but it's worth it for the lower rates you'll earn for years to come. Pay down existing debt. Improve. DTI. Before applying for a new loan, see if you can reduce your current debt obligations. This improves your debt-to-income ratio and can also bump up your credit score. Lenders favor borrowers with low debt burdens relative to their income. If you have high-interest credit card debt, for instance, paying some of it off will free up monthly income, making your profile look better. Some people consolidate debt with a personal loan, ironically using a loan to pay off others. But if you're looking for a fresh loan, say for a purchase, you want your financial picture to be as clean as possible. Each dollar of debt paid off not only lowers your DTI, it could also lower your utilization on credit cards and thus raise your score. Aim for that ideal DTI below approximately 35 to 40%. If it's higher, strategize. Maybe pay off a small car loan that's nearly done or tackle a credit card balance. Not only might you get a better rate, you'll feel more comfortable with the new loan payment. Consider a shorter term or smaller loan amount. We discussed how shorter terms often come with lower rates. If you can manage the larger payments of a 2 or 3 year loan instead of a 5-year loan, opt for the shorter term. Lenders may reward you with a rate discount and you'll save a lot in total interest. Similarly, borrow only what you need. Don't inflate the loan amount unnecessarily. A smaller loan is easier for a lender to approve and might come at a better rate. Some lenders have breakpoints. For example, they might offer a 1% lower rate if you borrow under a certain amount because they classify it differently. Even if not, you'll pay less interest on a smaller principal anyway. It can also prevent you from falling into a higher risk category. For instance, if your credit is borderline, asking for too high an amount could make the lender view you as riskier, leading to a higher rate or a decline. So choose the shortest term and smallest amount that still meet your needs. Your wallet will thank you. Apply with a cosigner, if needed. If your own credit or income isn't strong enough to get a good rate, consider bringing in a cosigner or co-borrower with better credentials. A cosigner is someone, often a family member, who guarantees the loan with you. They are equally responsible for repayment if you fail to pay. A co-borrower, on a joint loan, is similarly liable and typically has access to the funds as well. In either case, the lender will evaluate both of your credit profiles and incomes. Having a cosigner with an excellent credit score and solid income can dramatically improve the rate you're offered, because the loan now has additional backing. Lenders see effectively a lower risk. It's like having an insurance policy that if you can't pay, someone else will. Many lenders allow cosigners on personal loans. Make sure your cosigner understands their obligation. It's a big ask since their credit is on the line. But this can be a win-win. You get a much lower rate, and they help you obtain financing at affordable terms. For example, NerdWallet's data suggests that fair credit borrowers can get a rate reduction by adding a highly qualified cosigner. Just be sure to make every payment on time, as any default would affect your cosigner's credit as well. Leverage autopay and loyalty discounts. As mentioned, many lenders offer a small interest rate reduction, often 0.25% off, if you enroll in automatic payments from a bank account. Always take advantage of this if available. It's essentially free money saved, and it also ensures you won't accidentally miss a payment. Make sure you keep sufficient funds in the account to avoid any issues. Additionally, if you have existing relationships, like a bank account or prior loan with a lender, mention it or check for loyalty programs. Some banks have tiered client programs where deeper relationships yield better loan rates. While these discounts are usually modest, every bit counts, especially on larger loans. Over a 5-year term, a 0.25% reduction could save hundreds of dollars in interest on, say, a $20,000 loan. It's as simple as checking a box for auto pay during closing. And if it's your own bank, they might apply the discount automatically if you pay from your account with them. Shop around and compare. Offers. This cannot be stressed enough. Compare multiple lenders before accepting a loan. Different lenders might give you different rate quotes, as we explained. Take the time to get pre-qualified quotes from a few sources. Many online lenders and banks allow you to check your rate with a soft credit inquiry that doesn't hurt your score. Within a short time frame, FICO typically treats multiple loan inquiries within 14 to 30 days as one inquiry for scoring. Apply to your top choices to see real offers. Look at the APR, monthly payment, fees, and term for each. Also consider the lender's reputation and service, but cost-wise, focus on APR. According to Lending Club's tips, be sure to consider other factors like fees, loan term, and monthly payment, in addition to the interest rate when comparing offers. Sometimes a very low rate might come with high fees that raise the effective cost, so APR helps capture that. By shopping around, you might discover that one lender offers a significantly better deal than others for your situation. That's money saved. Even if the differences seem small, say 1% APR difference, remember over several years and thousands of dollars, that adds up. Timing and refinancing. While you shouldn't try to time the market perfectly, be aware of any temporary issues that you can improve before locking in a loan. For example, if a negative mark on your credit is due to fall off next month, and it could boost your score, it might be worth waiting to apply. Or if the Fed has been sharply raising rates, you might opt for a shorter-term loan now to get it paid off sooner, or even wait a little if experts predict rates might stabilize. More concretely, if you already have a personal loan at a high rate and rates, or your credit, have improved since, consider refinancing, taking a new loan at a lower rate to pay off the old one. Some lenders specialize in personal loan refinancing. As Credible's financial experts note, if you took out a loan when your rate was high, you might be able to refinance with a lower rate when conditions change. Just keep an eye on any origination fees to ensure the refi is worth it. By following these tips, you can put yourself in the best position to get an attractive rate. Preparation and comparison shopping are key. Lenders want to lend to you, but they also want to make money and avoid losses. If you can present yourself as a low-risk, responsible borrower, and if you pit lenders against each other for your business, you'll reap the reward in the form of a cheaper loan. Your personal loan interest rate isn't just a random number. It's the product of careful calculation by the lender, weighing many factors. Lenders look at your credit score and history to gauge risk, review your income and debts to ensure you can repay, consider the specifics of the loan you want, and account for the wider economic climate and their own cost of doing business. All these elements together determine whether you'll get a single-digit interest rate or a much higher one. The process might seem complex, but it comes down to two main components: your financial profile and the market environment. The good news is that by understanding how lenders calculate your personal loan rate, you've gained insight into what you can influence. You can work on improving your credit and financial stability, choose loan terms wisely, and shop around for the most favorable terms. A difference of a few percentage points in interest can mean hundreds or thousands of dollars saved over the life of a loan. Being informed gives you the power to make choices that lead to a lower rate. Finally, remember that knowledge is power in personal finance. Now that you know what goes into a loan rate, use that knowledge. Check your credit reports, compare multiple offers, and ask lenders questions if something isn't clear. If a rate seems high, politely ask if there are ways to lower it. Sometimes a slightly shorter term or adding collateral/cosigner might help. Even simply knowing that many factors determine your rate will remind you that you have options. If one lender's offer isn't good, another lender might view your situation differently. In the end, getting a personal loan at a competitive interest rate will make your financial goal, be it debt consolidation, a home project, or any major expense, more affordable and easier to manage. By preparing and positioning yourself as a strong borrower, and by leveraging the tips discussed, you can tilt the scales in your favor. Lenders calculate your personal loan rate with formulas and data, but you now have the roadmap to navigate those calculations. Do your homework, stay financially healthy, and you'll increase your chances of landing an excellent personal loan rate. Good luck and happy borrowing.